What's going on, guys? MMuniz here. Welcome back to the channel. In today's video, we're going to discuss what I'm calling the dynamic duo. Now, what is the dynamic duo? It is when you have a portfolio that includes two funds, both pretty popular, QYLD or QYLD and DIVO or DIVO. Now, QYLD may be the more popular and more controversial one for good reason. It has some really big benefits, and then has one big problem that everyone likes to point out that hates on QYLD. But luckily, with the dynamic duo, we actually have a solution for that problem, and that's what this video is going to be about. Now, one thing to keep in mind is I'm not a financial advisor, and this isn't financial advice. I make these videos because they're my opinions, and it's up to you guys to do your own research and then decide what you should do, what's best for you and your family. Now, a quick overview of this video. The first thing we're going to talk about is going to be QYLD, and then we're going to talk about the actual problem with QYLD. Then we're going to talk about the solution, which is going to be DIVO, and why it's actually a solution. After that, we're going to look at Portfolio Visualizer, which is a free website where you can backtest portfolios. You can do all sorts of cool testing. You can figure out what works best for your current situation. You can forecast out what might happen. All in all, it's a really awesome tool that I think people should take advantage of. And at the end of the video, just like all my videos, I'm going to talk about my own opinions on this and if I'm doing it currently. So with that being said, let's get into the video. So in the dynamic duo, as I said before, we have QYLD and we have DIVO. We're going to do a quick breakdown of QYLD, but we're not going to get too in-depth. Basically, we have a passively managed fund that holds stocks within the NASDAQ 100, and it writes covered call options on the entire index. It does that to generate high premiums on a monthly basis that it then pays out to its investors. So we know that it pays monthly, and it's a pretty high return of almost 1% a month, or basically 12% annualized. We do know that it's an extremely popular ETF within the FIRE community, or financial independence, retire early, and then also amongst retired individuals. We do know that it's pretty liquid, and it's been around for some time. It's not something brand new right off the street. But what is the actual problem with QYLD? Well, QYLD has a pretty big problem, and that is capital decay over time. As you can see, in the past 5 years, the asset price of QYLD has dropped 22.5%, and it continues to decline. If we go to a 1 year, we can see that it just continues to go down and then up, and then down and then up. So this is the major problem with QYLD. Whenever we have a drop in the NASDAQ 100 or in the market in general, QYLD drops as well, and it drops just as hard. The issue is when it rallies or comes back, because of the strategy of QYLD with the at-the-money call options, there's a cap on the actual capital appreciation allowed for the fund. So if you're following something like the QQQ, it might raise 10%, but QYLD itself may only go up 1%. This is the major issue. So if you're like me and you have different portfolios that accomplish different objectives within your financial management, you may want a specific portfolio that has a high yield for passive income, but you don't want to deal with the risk of just QYLD. This is where the dynamic duo comes into play. So let me introduce the solution, and that is by adding a percentage of DIVO to your portfolio. So you're going to have QYLD and DIVO. Let's do a quick breakdown of what DIVO is. Now, I already have a video on DIVO, and it's linked in the description if you want to go more in depth. But for now, let's just do a quick overview. So DIVO is a fund that is actively managed. It is not index-based. They focus on high-quality, dividend-oriented stocks, and then on a monthly basis, they write strategic call options on the specific stocks that are being held. They do not write covered calls on all of the stocks, only specific ones when the fund managers feel fit. The idea of this fund is to lower volatility by holding large cap stocks and stocks that show consistent dividend growth over time. You're going to get the monthly dividends just like QYLD. You're just not going to get quite as high of a return. With this being actively managed and not doing covered calls on the entire fund, they're able to actually show some capital appreciation over time. This is perfect. So why is DIVO the perfect complement to QYLD? Well, we talked about QYLD's biggest problem being capital decay over time, yet offering an awesome monthly return. Well, DIVO is almost the opposite, except it still has a pretty good yield. So DIVO allows for capital appreciation and doesn't have any decay over time when we're going off of the history. And DIVO also offers some good diversification when it comes to this portfolio that is prioritizing income on a monthly basis. You have QYLD with its NASDAQ 100 large cap growth, and then you have DIVO, which prioritizes dividend growth, large cap value stocks. So you're essentially protecting yourself from the risk of those high tech oriented stocks. Another cool thing about DIVO is it does offer some slight tax advantages because you're going to be collecting dividends from the actual companies. So a lot of your dividends are going to be actually qualified dividends versus ordinary income. You're still going to have a mix of both, whereas QYLD is just going to be that ordinary income unless they do return of capital, which we didn't see in 2021 at all. So now what is the perfect ratio for this dynamic duo portfolio? Well, we're going to use a tool, like I mentioned before, called Portfolio Visualizer. I do have this link below, and I'm going to walk you through it, and we're going to look at two different options, and it's going to be up to you guys what you choose. At the end, I'll tell you which one I like the best. Okay, so using the Portfolio Visualizer backtest portfolio, we're going to look at the timeline of 2017 to 2022, and that's because DIVO came out in 2016. We are going to do an initial amount of $25,000. Now, if you're retired, you could change this to $250,000 or $500,000 to see how much returns you would actually be getting, but I'm just going to do an amount that's realistic for me since I'm just an average Joe. Now, rebalancing, we are going to rebalance annually, which means we're going to take advantage of the fact that we want to keep the same percentages of each one. So, for instance, if our QYLD is decaying and our DIVO is growing, we're going to sell some DIVO annually to buy some more shares of QYLD. Now, we are not going to reinvest dividends because the idea of this portfolio is going to be to take the dividends, to take our family on vacation, to retire early. Whatever it is you want to do with these dividends, you are making this portfolio for one specific thing, and that is passive income. That is the goal of this. Now, we are going to have two portfolios. We're going to have the dynamic duo, and we're going to have the dynamic duo on PEDs. And then portfolio 3 is just going to be 100% QYLD because some people believe that you can just have QYLD and collect the dividends and be fine. I don't agree with that. I believe in diversification, which is why we're making this video. So we're going to scroll down, and as you can see, you have the option of the dynamic duo, which is my preference, 50-50, or you have 70% QYLD, 30% DIVO. You can do your own using the link below, but just for this video, we're going to stick with these. Now, when you come down here, you're going to see we started with $25,000, and you can look at the graphs. You see right here is the $25,000. The orange is going to be the QYLD only. The red is going to be the higher percentage of QYLD, and then the blue is going to be the 50-50 mix. And as you can see, at no point other than March of 2020 does the dynamic duo or the 50-50 mix go below your initial investment. And we've gone through multiple phases. We've gone through a bull market. We've gone through a massive crash, the COVID market correction in March of 2020, and now we're in a current bear market. However, you can see that your initial investment is still pretty healthy with the dynamic duo and even with the higher percentage of QYLD. Now let's go down a little bit more. Another cool thing about the Portfolio Visualizer is you can look at the annual returns. You can see in 2018, the return was negative, 2019, pretty high, 2020. There's a lot of analysis you can really take advantage of with this. One thing I like to do is look at the returns. You can look at your exposures. You can see, obviously, you have large cap value, large cap growth, which is both of them. We talked about that already. I like to look at the annual returns. Now, with the annual returns, you're going to see the income that we collected on a yearly basis, and you can see it for each one. So yes, QYLD is going to have the highest income. The monthly return is going to be the best. It's going to be a 12% yield. However, your balance, your portfolio balance is going to significantly decline over time. You started with 25,000, you ended up with 21,000. If we look at our dynamic duo, our portfolio is gaining value. We're not reinvesting dividends. We're just taking that money and we're spending it on our family. So with the $25,000 portfolio, you've got $1,600. That can probably buy 3 flights, a place within the U.S. You got it better. In 2021, almost $2,600 with a 9% yield. So even with a strong portfolio that is now overtaking the capital decay of QYLD, we're getting a 9% return. That is a fantastic return. Just a quick example. What if I change our investment? Let's just say we have $300,000. We are, just about to retire. You could go back to your annual returns, and if you're doing the 50-50 mix, you're getting $30,000. $30,000 just in your income. Now, this is going to be passive income. So you're collecting that money. You can be like, oh, well, I spend $30,000 a year in expenses, so I probably need to have a bit bigger of a portfolio to be able to take advantage of this, but you're getting really close. And remember, this is just one portfolio that I'm suggesting. You should still have other forms of diversification. Maybe you're just holding the S&P 500. Maybe you're holding, a bunch of growth stocks in a Roth IRA. This is just one portfolio for passive income. So to wrap this video up, QYLD's biggest problem is capital decay over time, or your portfolio value falling over time unless you're reinvesting dividends. The dynamic duo, a 50-50 balance of DIVO and QYLD, allows you to still have a high monthly yield without having to worry about your portfolio declining over time. I think that this is a fantastic solution for anyone looking for a small portion of their portfolio to provide passive income that they can use on a monthly basis or quarterly basis to buy things for their family, potentially retire early, do whatever it is you guys need to do with your money. To me, I haven't put any money in QYLD in a long time, but I have been growing my DIVO over time. And at some point, I'd like to be at a 50-50 mix. I think that's a healthy mix of both of these. Now, I do have other funds that I'm holding on to and I'm investing in, but this is just one small portion of my financial future. So I want to hear from you guys down in the comments below. What do you think of this? Do you have a better plan or a better option? I'm curious. I'll do my best to respond to every single comment. Now, if you haven't already, make sure you smash the like button down below, subscribe to the channel, and I hope to see you guys next time. Take care.